All right, gang. I think we're ready. I think audio and video is good to go. Yeah. All right. Excellent. Hey there, everybody. Welcome to our pre-morning show for October the 29th. The month of October is almost gone. Unbelievable. All right. So welcome to our show. So a couple interesting things happening this week. Just yesterday, I finished my the first webinar of our upcoming ETF class. Super stoked for that. I'm going to touch on a little bit of that here in today's morning show. And that was a late night, went through a lot of the comments and questions from the webinar, and great feedback. There's a second webinar coming up, so I'll get you guys the login for that. We're going to take the next step into what I'll be teaching next Saturday. So we've got that going on. What else do we have going on? Well, let's just jump right into the charts, because what we have right now, and I'm going to take you to my multi-chart. And what the multi-charts are, all right, here we go. So what the multi-charts are, there we go, is a layout that allows us to see the main market, the main sector, the main index, the main grouping, if you will, of a number of individual stocks. And right now, more than ever, and I'm going to change this to the daily time frame on all of these. This is TradeStation, by the way. So what you'll notice on this layout is not only is the broader market, that's the market in the upper left-hand corner, not only is that yellow meaning it is not trending. It's in a choppy market. Notice I didn't say it's in a downtrend. You would think that people would somehow be able to differentiate between and just know what we're panicking about right now. Please, don't subscribe to what you're seeing on financial media in the panic. Remember, they're always trying to tap into our lizard brain, keep us hooked into whatever the drama, whatever the saga, whatever that negative narrative is. It's totally fear-based. And so we look at that one candle. I mean, I get that this is, clearly nobody wants to see a candle like this, but this is the first red grab candle we've seen since the 24th of September. All right. I think we're going to continue to chop. This is a distribution market. Within a distribution market, we're going to see moves higher, we're going to see moves lower, and we're establishing a distribution range. I think the Darvist here has done a pretty good job for us identifying what that range is. Here's the lower end of the range. I'm just using the Darvist level. And here is the upper end of the range. Again, using that Darvist level. So within this, gang, we're going to be able to sell off dramatically. We're going to be able to rally dramatically. What are going to be the same catalysts for a rally are going to be the same catalysts for a sell-off. It's just the inverse. So the election, let's take the election out of it because that's a finite thing. We know on that date, give or take a few days, I'm sure there'll be some drama around how long it takes to count the votes because so many were mailed in, and I'm sure there'll be some drama there that news will milk. But we have it's a real narrative. But we have that, and there's a finite date. There's a cutoff to that. However, the three that are more problematic are the ongoing COVID saga, the ongoing vaccine saga, the ongoing stimulus saga. I say saga not to belittle any one of those three themes, but saga in the way that Star Wars was a saga. It took 6 episodes to tell the story, right? So that's what I mean by saga. It's an ongoing thing that has a life of its own. And we're going to notice that when the saga is going negatively, there's no vaccine optimism around the corner. COVID numbers are going up, and we're not seeing stimulus. We're not seeing the helicopter money falling from the sky. The market's not going to like it, but it's still in the same range it established, basically, as you can see here, with the highs that we established back on the 2nd of September to the lows that we established on the 21st. We are still inside that September range. The bottom line is, gang, we sell off a number of points. It doesn't matter. We're still basically traversing a well-worn path. All right. So as long as you can keep that in mind, it's a whole lot easier not to get caught up in the ongoing narrative. Now, the trick then becomes, okay, Rag, we're with you so far. find the relative outperformers within the individual sectors, within the individual indices. But how do we know if we should be bullish or bearish? Because in the range, we know, and maybe you don't. So let's talk about what you do with a ranging market. So I've always said in a range, your edge, as in your advantage, is at the edge. Some of you may have heard me talk about that before. Yeah. All right. So the edge is going to be the same process. Let's use some Darvis levels, and we can even throw in volume levels. We can throw in a lot of different things, but this is probably the easiest and the best place to start. So grab the extremes. Now, there might be some minor levels. We might have some other Darvis levels to look at, but that's pretty much your 2nd to 24th or 1st zone, September 2nd to September 24th. That's your zone, and we're still trading within that. But what we are doing now is, and I'm going to use the calendar here in the upper right corner. So today's the 29th, the 28th. We're going to count back 10 days. 28, 2, 3, 4, 5, 6, 7, 8, 9, 10. And that's on the 19th. What I'm going to do is I'm going to re-anchor my VWAP to the 19th. Okay. And what you'll notice is we are still below both volume weighted average prices. Now, being below the rolling, that's what I call the rolling 10-day. It's a rolling 10-day VWAP. Being below the rolling 10-day VWAP gives me insight. So let's say we're below the 10-day, but above the 1 month anchored. That's choppy market territory. That's two-way trading. I will tell you, I do not like two-way trading. I don't like having to start the morning off and saying, well, I could be long or I could be short. That's actually much more difficult. Now, there are two-way traders out there. I've tried it. I've been day trading on and off since the mid-90s. So, for like a lot of you here in this room, day trading, not your first rodeo, the kind of chop that we're seeing right now. I determined early on in my career that it was better off to be a one-way trader. Like any good road trip, you can't get to where you're going by getting off at every single exit. And I find that for me, I'm more productive, I'm clearer, I know my plan of attack, I follow my trading plan better, and my win ratio is better. My follow-through is better when I'm a one-way trader. I don't think we have an edge when we're open to anything. I think we have an edge when we've done the analysis and we realize one particular direction is better than another. And so there are going to be windows where we can see that two-way trading is going to be something we have to be open to. And that's going to be when we're in the vice grip of the rolling 10-day and the first of the month anchored VWAPs. Once we're above both or below both, it's a whole lot easier. Now remember that rolling 10-day VWAP looks different now because it's constantly rolling. But if you've been watching me for some time, especially in the Simpler Futures room, you'll notice we were sandwiched within it for about 5 sessions or so, 5-6 sessions. Difficult sessions, all of last week, very difficult. The very beginning of this week until Monday firmly broke the first of the month anchored VWAP, I had to be open to two-way trading and I got chopped up. That I know is a function of being a one-way trader. Two-way traders will typically do quite well in that very small window. Again, the window lasted days. So I know that the minority of time we will be in that VWAP vice grip. Majority of the time we'll have clarity either above or below. We have clarity again. It's just bearish clarity. Bearish clarity is not as good as bullish clarity. Bearish markets are not as predictable as bullish markets. So even though now I'm going to be open to short side only trades, it's short only. When for those of you that are in both the pre-market show and then join me in the futures room, which I'm going to be jumping into here shortly. Those of you that have followed me in that room, and I'm actually opening it right now so I can be ready here at 20 after. All right. So let's see. Be nice if I logged into the right room. All right. So the idea is, I will get to my point. All right. The idea is now I can be bearish, but remember those same three narratives, coronavirus, vaccine, stimulus, those can create those bouncing days. Down moves, down trends, bearish bias, they're extremely susceptible to what we call those face ripping moves higher. That's what they're known as in the markets, just face rippers. It's an awful analogy, but I guess that's really what they feel like. Now, what that is a very violent short squeeze. Some of you might be wondering what the heck's a short squeeze. There's a long squeeze too. Short squeeze just means that when the markets are moving lower, and because most market participants are momentum traders, they'll just jump in on the direction that the train is heading in. And if it's heading lower, they'll get short. When some good news comes in, or some support comes in, or the buyers come in and they're triggered to want to start buying, and the shorts are overpowered by the longs, by the buyers, they are squeezed. Same thing happens to the long side. But just short squeezes end up having so much more attention, because when they happen, they're far more violent. But you can call any market really swift correction a squeeze. It's squeezing the prior participants because they're now being overpowered by the opposite direction of price action. So short squeezes, I think, are much more likely to happen as we head down into the point of control for the year, as we head down, which is, actually, let me start with the Dow, since that's the one that's been hammered lately. So I'm bringing up the Dow, daily time frame, by the way. And the class that I'm doing, by the way, gang, is a daily time frame class. I think daily time frames are so often overlooked because we're doing a lot of multiple time frame scans. We're looking at 5s, 15s, 30s, 60s, etc. I eliminated that nearly completely. I say nearly because I'll still do it in Forex. But I've nearly eliminated that from my trading. I'll have one short-term time frame. I'll have one long-term time frame, and that's it. And I cannot tell you how much more clarity it's brought to my trading. I'm either day trading a very short term. It could be a 1, it could be a 2, it could be a 5. Don't get hung up on the actual time frame, but focus on, I have one short-term time frame and I have one long-term time frame. I very seldom have something in the middle. Something in the middle, by the way, will be usually a 30 or a 60. So usually it's one or the other. In the morning, I'll day trade, focusing on that short term. And in the afternoon, I'll do what my class and my webinars this week and next week will be about, which is, where's my clarity on the daily? Where's that multi-day or multi-week opportunity happening in a relative outperformer that I could build an options position within? So I can divvy my day up, and I'm not trying to do the same thing at the same time. 2 hours in the morning, day trading, and about 2 hours in the afternoon. Even sometimes it's less than that. I can do my end of day, you can call it swing trading if you'd like, relative outperformer, trend following, and that's really what it is. It takes about an hour. Really just takes about an hour to set the alerts, to set the levels, and determine what strategies, option strategies, that I will use to engage the market. Okay, having said all that, this is the second half of my day conversation, meaning, where is this Dow right now? And it's testing a 200 exponential. It's below the Darvis level. We're coming up on the mean of our volume weighted average price standard deviation measurement, the V score. We're in a zone where if I can see a minor low get put in today, I'll take a look at today's candle for a setup into tomorrow or Monday. I don't like Friday entries as a general rule, but if the criteria is met, I can look to start building a particular options position based on what we're seeing here. But this is really a conversation about overbought, oversold, and we're heading down towards oversold levels. So let's go back to that ES. And I'm looking at the S&P futures. And so again, what I'm going to be looking at today, after a dramatic sell-off day, is an inside day or a minor low. It's the same thing those of you in the futures room have heard me talk about in the past. It's the same thing that you guys have probably heard me talk about in our time here together in the pre-market show. A minor low would mean that we put in a slightly lower low than yesterday's session low. And that would be the beginning of the pattern. So today I'll day trade, but I don't have a lot of insight yet on what I want to do on the end of day charts. That's going to take a little bit more time. And you'll see this white line here. That is the point of control. White line right through there. That is the point of control for the year, meaning that that's the level that we have seen the single most volume in for the entire 2020, right there. That's that level right there. There's amazing, powerful levels there. They're amazing because they're volume-based, and they're powerful because they reflect a broad base of opinion where people have dug their heels in. So volume levels are very often overlooked in the markets because people are focused on price levels. Think about what most indicators are calculated off. Price, which is fine. My wave is price. My grab candles are price. The Darvish is price. But don't keep stacking more and more and more price-based tools on your charts. Think about volatility-based tools and also volume-based tools. That's when you'll have a full, and even in some ways, time-based tools. Volume, time, volatility, price. Those are the four things you want to measure. You really do want to have some way to measure all four. What most traders do is they just keep getting more price-based tools on their charts. The reason for that is you can't really do a lot with volume, volatility, and time. There's not as many variations of slicing and dicing that input into a gazillion indicators. Prices, you can do that to infinity. Hence, we have tons of price-based indicators and very, very, very few volume-based indicators for traders to choose. I run all four ideas on my charts. We talk about the economic calendar. That's a time-based tool. We talk about the end of the month, end of the week. We talk about pit bull tendencies. Seasonals would be time-based. That's one way to measure the market. Another way, volume. How much volume is at a particular price level? It's not always going to accompany a wick or a candle body, which is what most people will draw support and resistance and trend lines based on. Volume is much stealthier than that. And then finally, volatility. How much price movement do we historically see in a particular market on a given day, on a given hour? And when I say historical, what has been the tendency for the past 6 months, not the past 6 hours or 6 days? Historical volatility. So you put all that on your chart. Now you're starting to get a different picture of behavior. So our volume tool, our VWAP, that vice grip I talked about that we've now escaped, we're clearly bearish. Yes, we are susceptible to short squeezes. Short squeezes are much more violent than a long squeeze. But I think that because we're in chop, the short squeeze is going to make a lot of sense once we get down to possibly, say, 3,200 and that point of control in that previous low area. So I would be much more apt to look for that short squeeze there, and I'd be much more apt to look for a long position down there. Okay, so let's also take a look at our intraday today, because one of the questions we have is there gap psychology? Remember our 6 points. If you're not familiar with the 6 points, go back into the earlier episodes, episode 1, episode 2, and you'll see the 6 points we talk about. You need to know what's on the economic calendar. You need to know if there's a gap. You need to know the rate of change of the economic data that's coming out, so on and so forth. So you can check that out. And one of the first things to answer is no, we do not have gap psychology today on the ES or the YM. We don't have it on the NQ. In fact, what we're seeing right now is a minor low on the YM. Looks to be an inside day on the NQ. We won't know until the day is done, by the way. We won't know that. And then on the RTY, more punctuated minor low. The YM is a subtle minor low, so slightly more punctuated minor low. So let's see how today follows through. Any one of these inside days could become minor lows. But once we put in a minor low, it's no longer capable of being an inside day. It's no longer capable of trading within the range of the prior session. So bearish bias, no gap fades, and I'm going to take a look at the upper end of ranges for opportunities today. So that's what I'm going to be doing when I go into the room here in just a moment. What are my opportunities for shorts? V-score, HPMR, it even could be a clearing range, breach, retreat, but I'm going to be focused on the short side of the market. And I'll tell you, after months and months and months of being pretty much long only, this is going to be a strange experience. I mean, we had small pockets of two-way trading and chop, but this is a rarity. The vice grip is a rarity, and actually within the course of 2020, having bearish directional bias has been a rarity. For me, I just call them minor lows. Christopher, there's no major low. No, it's not like it's a major minor. The pattern is called a minor low. Good question. No, so there's no major low. Yeah, there's no major low. All right, gang, I'm going to head on over to the day job. It's time to start looking for some opportunities. It's 20 after 9. Thanks as always for joining me for these pre-market shows. They will be almost every day unless I've got something I've got to unless I've got a meeting that I just simply cannot move. But I'm going to do a better job of trying to keep this 9 to 9:20 open. And as we go into November, this is going to become a permanent part of my schedule. So hope you've been enjoying it. I hope it's helpful. Give me some feedback. Let me know what topics you'd like to take a look at. What else I can do to prepare you for the morning. I'm preparing me as well as I'm preparing you. So I hope this helps, and I'll see you tomorrow. All right, gang. Be good to each other.